Mike, I want to give you the first comment here as we finished out this August week. It's Friday the 13th, but everything turned out okay for the bulls.
Not exactly a jinx. I think the one feature of this market that has to be your main takeaway is the persistence of the rally. So it's not so much that this is kind of a gangbusters buying binge. It's much more about people who have allowed their equity allocations to rise with the markets or just have no reason to trim them back or no perceived reason to trim them back. So it kind of finds a way in this kind of low energy fashion to click higher. We are in the 10th straight month where we've had an all-time high. That's only happened about 3 times in the past 60 years. That usually has been kind of in the middle range of a bull market, not near the peak. So, a lot of these reassuring kind of historical precedents, when you have a market that has kind of refused to buckle like this, it usually doesn't mean it's about to have some kind of long-lasting and deep downturn. So that might be some reassurance, even if we get some bumps in the late summer.
Interesting. Mark, I want to bring you into the conversation.
Your headline.
Go ahead, Will.
We were probably having a very similar thought, Courtney. I was going to say, Mark, give us your headline views at the moment. More likely to have a big surge into the year end or a 10% pullback?
I think neither, Wilf. I think resilient is the right word to use with this market. I mean, we've had lots of naysayers talk about the things that would derail the market, that was overheated, that obviously we had a hot SPAC tape, there's too many IPOs, rates are going to climb, Fed's going to taper. I heard everything, and guess what? That has not happened. So I think there's going to be a continual grind higher. Numbers will exceed. We'll get the Delta variant under control. The U.S. will be a much better market, I think, than global, because some of the Delta variant and other variants are hurting those economies more than ours. And I think we're going to have the consistent grind higher, and that's a great backdrop for equities.
Lindsay, we haven't really talked much about inflation and whether or not it's persistent or transitory, but whatever the case, how much does that play into where we are in the economy? If we're near peak, if we can make our way through it as we're looking through the back half of the year with the data points that we got this week?
Yeah, the data points we got this week were somewhat conflicting, CPI versus PPI. CPI is moving in the right direction, though. It's moving lower, 4.3% on a core basis. And we did see improvements in some of the key areas that had really worried investors, worried about them sticking around, like used car prices and rents. And so what I want to watch when it comes to inflation really is that rent number to make sure to find out if it's transitory or not, because when those go up, it's kind of sticky. Same with wages, but higher wages are also good for the consumer too. So I'm less in the camp of worrying significantly about that. I think as far as where we're at in the business cycle, I think we still don't know how transitory inflation is just yet. Hopefully we continue to see the trajectory downward in these rates, but it's going to be something that we have to keep an eye on, and I don't think we're really going to have a good grip on it until we get a couple readings into the end of the year. And so it's really, for me, a wait-and-see mode on inflation, but I am cautiously optimistic on it.
Mike, did we get a glimpse from the consumer sentiment data of what the Delta variant could do if it prolongs too much longer? But at the moment, the market being resilient and I guess hoping that it's going to dip back down again, the variant, and sentiment up again before it kind of has any meaningful negative effect on equities.
Yeah, first of all, it's a very extraordinary drop in the University of Michigan consumer sentiment number in terms of the magnitude month over month. Usually it's associated with recession. So clearly there was definitely a major mood shift. But probably reflecting most of what we already know, which is the surging numbers. So it's more of a lagging than leading indicator. Market has so far been okay with the idea of, fine, we'll slow the pace of some of the core reopening activities. Maybe businesses wait a little while to have people come back to work. But we know that we can kind of continue to grow as an overall economy. And at least the way the market is reading it, it leaves a little more in the tank for growth down the road. So we're transitioning from this idea of a run it hot kind of boom time economy in the spring to more of a somewhat slower, somewhat steadier, but maybe more elongated recovery. That's the bright side view. That means that we're not going to have any real setbacks. And to me, that's the way the market has been tacking. By the way, Treasury yields for the week didn't really do much. In the early part of the week, they popped on some of that inflation data. They've managed to come back in, and especially that consumer sentiment number today.